Hello, everyone. I'm Bill from PowerEmini.com, and I got my little splash screen up here. The first thing I want to mention is that we're actually a software company. We've been developing software and trading systems since stocks traded in fractions, if you can believe that. But what I'm here to actually talk about is give you some ideas on some good educational stuff where we're moving beyond the trade setup. But I just wanted to mention that we are primarily a software company, and all the education, all these good ideas are basically my opinions only. You can see the disclaimer on our website. This is for educational purposes, and we give all this education to our software users for free. So let's get into it here. Basically, what I want to talk about is moving beyond the trade setup, right? So over all the years I've been doing this, so many traders, especially new traders, and even veterans like myself, we're all focused on the trade setup. We're looking for this perfect trade setup that's going to work every time. It's kind of the end all be all. There's a lot of people out there looking to trade the markets. They're completely 100% focused on finding the best trade setup that's going to work every single time in every market in every environment. And this presentation is based around trading intraday futures. I just wanted to let you know that up front. But some of these concepts actually will work no matter what you're doing. Different time frames, different type of instruments. But anyway, there's so many futures trading setups that we can experiment with and learn. Infinite numbers of indicators, combinations of indicators. And so, we've all experimented with that. We've all jumped around. But here's the thing. We run into a problem because the same trading setup, right, based on a couple of different time frames, you could be in a downtrend on one time frame and an uptrend on the other one. So you have to decide, which of these time frames are you going to trade? And so anyway, long story short, the kind of confusion that goes along with trade setups leads a lot of people to just jump from one trade setup to the next one. They find the perfect candlestick setup and it works, and then the market environment changes. And they think, well, if I just added one more little piece to this puzzle, if I added another indicator to this, that would have kept me out of that trade where I got stopped out. So what I'm here to tell you is that the trade setup is just the tip of the iceberg when it comes to the trading process. And what we can do is we can create a winning edge by first finding a really good setup. But what we want to focus on is what happens after the trade setup, right? And so I'm going to talk about position sizing and money management and stops and trailing stops and targets and all that good stuff. And hopefully, you have a good repertoire of trading setups that you use. But I'm sure most of you know, and especially those of you who've been doing this for a long time, know that all trade setups have a failure rate, right? So what we're looking to do is gain an edge by refining what happens after we take a trade. To repeat myself, all trade setups have a failure rate, right? And I think most of you know that. We can have high win trade setups. We can have ones that win most of the time. We can have trade setups that only happen every once in a blue moon, but they work, they have a really super high win rate. Or we can have trade setups like out of a standard technical analysis book that you see, frequently intraday, but the failure rate on those may be more than the certain other ones. So anyways, you look to buy support or resistance. You look to short overbought when the market gets overbought. You look to buy breakouts. All these type of things work in certain market conditions, and then we get a market session where it just chops around sideways, and all of a sudden, there's no trend or anything, low volume, low participation, and that trade setup doesn't work anymore. And so you think, man, I got to find something better. This thing's just not working. And over time, what you learn is that there's no one holy grail setup that works all the time, every time, in all market conditions, right? So I don't want to get too far into this, but I have a candlestick book that's about 3 inches thick, and I pulled it out because I remember when I originally got this thing, I was thinking, oh man, let's see what the best candlestick patterns are, right? And all this and that. And come to find out, and in the book, they've tested every single candlestick pattern over thousands of trading days and come up with all the statistics on it. And I was blown away to find out that the success rate on a lot of, the candlestick patterns are like 50 to 60%. And so I was a little dismayed by that, but I'm not knocking candlesticks or patterns or trade setups. I mean, it's a very integral part of the process. But all this stuff, no matter what you do, eventually you're going to learn that every single trade setup's going to have a certain market conditions where it doesn't work so well, doesn't follow through, you get stopped out a lot, you don't get triggered in, that type of thing. And so what we want to do is we want to move beyond the trade setup and see what we can do to improve our edge by tweaking the other little parameters of the trade, right? There's a failed breakout trade. Um, here's a nifty little just a nifty little set of candlestick buy and sell patterns. Love candlestick patterns. I mean, I've always been a big fan of them, and I can tell a lot by candlestick patterns, but guess what? Sometimes this is how it starts, and then this is how it goes, right? So candlestick patterns are great. Sometimes they even work. There was one pattern in this book that had like a 70, I think it was like a 70-something% win rate. Come to find out, it only happens like once every so often. You could sit around for weeks and not get this particular candlestick pattern. And so that's kind of the trade-off there, right? I did come up with the candlestick pattern myself that I think has a really super high win rate, but there's always a drawback, right? Like I say, nothing's perfect, and even this is not going to have 100% win rate. But if you see this exact setup, if you ever see this exact setup, you're looking for a 1-tick profit target, and this works a lot of the time. This is a joke, of course. So anyway, okay, so here we go. No trade setup's perfect. You can't figure out the market. Every session is different. You can have a great trading session one day, and then the next day the market just bounces around in a 6-point range all day and goes sideways, and your trade setup either doesn't fire off or it doesn't work. So even if we have the best trade setup ever invented with the highest win rate, as soon as we get filled on that trade, right, then we're exposed to different things that are not governed by the rules of technical analysis, right? News hits the wires, a big sell order comes in, any number of things, a tweet comes out. And so, we can only perfect our trade setup so much. What we want to do is we want to refine our edge by focusing on what happens with the other components of the trading process after we actually enter the trade. And so now we're getting into the meat and potatoes here. So we can focus on trade management, money management, and account management. And I've got a little slide on each one of these. The entry trigger, we can refine how we actually take the entry on our great trade setup with a high win rate, right? We want to focus on the entry trigger, and there's variations on the entry trigger too that we can refine and perfect. We obviously are going to use stops as intraday futures traders, and so that's an important aspect of it. I mean, setting our initial stop, managing our trailing stops, setting profit targets. I'm going to talk about break-even trades, scaling contracts. So these are some of the things that we can do beyond the trade setup to increase our odds and give us a little bit of an edge. And then, of course, money management and position sizing is another really big, crucial aspect. So we can position size based on current market conditions, intraday ATRs, ranges in the market. I have a cool little technique where you scale based on the prior week's performance that I'll talk about real quick. And then, of course, there's the biggie, only trading with risk capital. And we actually have an in-depth video on our website that goes into this. I think it's like 40 minutes long, but it really digs into this topic. And I'll give you the real quick rundown, and I think it'll make a lot of sense to you, honestly. They always say, hey, only trade with risk capital, but we have this little technique that we use that goes a long way towards making that a reality. So Real quick, to get an edge in our futures trading beyond the trade setup, we want to focus on our entry points, our entry trigger. We want to focus on refining our trailing stops, and we want to focus on targets too. And so that's something that we can use to, once we have a really good setup, these are like little things that we can use to refine the process and increase our odds that we're going to have a higher win rate. Right, so let's talk about the entry trigger for a minute. There's tons of ways to actually take an entry, right? When you get a valid trade set up, typically, and especially like candlestick patterns and that, there's always a confirmation, right? So generally speaking, when we're taking intraday futures trades, we're looking to confirm the entry by either a move past one of the prior highs of a price bar or candle, or a close above a prior high. Like I said, a candlestick pattern with confirmation. Maybe we're looking for a cross of a moving average and then a close. And so basically the gist of it is that a good system should actually have a trade entry trigger, so you know when to take the entry based on your setup and when not to take the entry. And there's a lot of different variations on that. So this is what we like to use, or actually what our software uses. We like a 1 minute close. So when we get triggered in a trade, basically we're looking for a 1 minute price bar to actually close above the what we call the trade price barrier. But the reason for that is that a lot of times we'll see the price, start a trend in one direction or the other, and you'll see a whole bunch of like price bars like poke up, poke up, poke up, and then you get a reversal, obviously, and it starts moving the other direction. So to keep from getting sucked into a false move, in theory, what we look for is just a 1 minute price bar that closes above what would be our trigger line. Right, so that should make kind of sense. And then of course, placing a stop loss is a whole nother thing that I'm going to talk about here, but there's different ways to place stop losses and different ideas that can be experimented with. But obviously a stop loss, when you're trading intraday futures, the initial stop loss is crucial, right? And if you're not using stops, see me after class. I actually talked to somebody recently that said that they didn't use stop losses trading futures, and I kind of scratched my head. I wasn't gonna argue with the guy, but boy, I'll tell you what, it's in a lot of our educational stuff, the first thing that we recommend is that as soon as you enter a trade, that your stop loss, is placed immediately, because I've seen ES move 30 points in 1 minute. It's been a long time, but I've seen it. So anyway, the dilemma with, your initial stop loss is if they're too tight, they're going to get hit repeatedly over and over. And if they're too wide, then you're going to get hammered, losing money. So good stop losses are typically, in my opinion, based on ATRs and current market ranges, because the market changes from day to day, session to session. And I've also talked to people that have little strategies where they say, I always use a 6-tick stop. And so I wonder about that. And hey, things like that can work for certain people if they've got a good system and strategy. I never knock it. I'm always looking for a better mousetrap myself. But what I always think, and I sit here and when I'm trading the ES and watching these price bars move, I've seen 6 ticks, just like random price behavior in the middle of a 5-minute bar, right? Like you're sitting here and every 15 seconds you're getting 6-tick move, random price moves up and down. And so in my opinion, you have to base your stops and your targets based on what the current price action is. You have to adapt to what the market is giving you today. So stop losses are typically placed relative to a recent high or low, support or resistance, pivot points, ATRs, but ideally the stop should be placed relative to current price action, right? So saying something like I always use a 6-tick stop is not relative to the current price action. And the other thing is, like what I mentioned, you don't want to get your stops hit repeatedly. So you want your stops to be kind of calibrated. Same with profit targets. Profit targets to me are important. I know some people use targets, some don't, but part of our strategy is we use profit targets so that we can get our trades to break even, right? In order to get to break even, you have to take partial profits and move your stop up. So targets allow you to scale out of a trade. Ratcheting your initial stop when the price moves in your favor can allow you to get to break even. We're real big on break even. My number one goal has always been to get a trade to break even as quickly as possible. So trailing stops can keep you in for an extended move. And when you latch on to a big fish, you want to land it, right? So using a 6-tick stop and a couple of point target is, can work for some people. You need an extremely high win rate. We prefer to shoot for the bigger targets, right? And so trailing stops combined with taking partial profits is a winning strategy, and you can get your trades to break even. Break even trade is something that everybody should think about introducing into their trading strategy, because a lot of people think of a trade as either a win or a lose. It's a binary event. Well, I either lost money or, I made money on that trade. So here's something interesting. If you introduce the break-even trade, now only 1/3 of the potential outcomes are bad, right? So you got a winning trade, you got a break-even trade, and you got a losing trade. But guess what? Only 33% of them now are bad. The rest are either good or not bad. So break-even trades, I don't want to get into this too much here because I don't have a whole lot of time for this, but if you get your trades to break even, you eliminate the risk of loss, then the world is your oyster, right? Then all of a sudden the market starts making an extended move. You can sit back, let the trade play out. It reduces the stress. And so that's basically what we're looking to do. We're looking to get the break even first thing, and then we can manage the trade going forward. So here's a little trick. Here's a little takeaway trick that my cohort Jeffrey actually came up with a while back, but it's a real simple strategy. You take your trade set up, you take your entry. As soon as you get 3 price bars with 3 consecutive lows that are higher than your entry, you just move your stop loss to break even. That's a real simple trick. There's a few other ones that we can use. We can set a couple of targets. We can take profits at the first target, and this is what we call the virtual break even, right? It's not where you move your stop to your entry, it's where you move the stop up an equal distance to where you just took profits. So, say your first target's 4 points, you take profits 4 points up, and then you move your initial stop 4 points below your entry, and guess what? You're at virtual break even. If the price comes back down and hits your stop, well, then you didn't lose any money, you didn't make any money. You just paid a commission. So again, a fixed stop doesn't make sense since the market environment changes from day to day. The volatility, the ranges, the ATRs, that's what I think you want to focus on. So this is, I don't want to talk about this too long. I just included it because this is a diagram of what I just mentioned, getting to virtual break even by selling a contract at the first target. And then you let you either have a second target or you manage it with a trailing stop. I've got more about this on our website. If you want to read the blog post about this, you can visit it. We believe firmly in intraday futures trading based on the current ATRs and ranges that are in the market right now. That way your trading system adapts to all market conditions and ever-changing environment. And the best way to trade what the market's serving up today is using today's ATRs for whatever time frame you're trading. So people talk about volatility. I always call it range expansion, right? When the ES is trading in a 4, 5, 6 point range for an hour at lunchtime or something, that's a lot different than, on Fed day when you're seeing 10, 12, 15 point ranges on 5-minute charts. So it makes sense to adapt your trading to the current session's ATRs and ranges, right? And so as an example, you don't trade the same way on a lazy Friday in August as you would when Powell's doing his press conference after a Fed announcement, right? Like Fed announcement days, you get serious range expansion up and down all over the place. Very risky to trade, but it's just an extreme example. So adapting to the market conditions is something that you should really sort of strive to work with, because that will improve your results. So one size doesn't fit all when it comes to trading size, right? I'm going to be honest with you. There's good market conditions and there's crappy market conditions. I hate to say it, but sometimes the market conditions are just not conducive to trading. And so a good trader is going to adapt, and they're going to be able to spot, whether the trading session right now, as we're looking at it, is a decent trading session, whether we're getting, volume, price action, trending movement, or whether we're just randomly chopping around sideways with low volume and participation. And basically, what I think most traders should do is trade more aggressively when the market's hot and acting well, and trade more conservatively, in suboptimal conditions. Like I said, the dog days of summer when there's no price movement. Um, Simple trade plan. We actually have sort of this detailed out on our website for our software users. This is what we recommend. Like if you're starting a new system, it's real simple. You start with a couple of MES contracts, right? You're trading lunch money, and you spend a week or so learning the system and figuring out your triggers and what you're doing in that. But a new trader, I think this is a great way to start off, real conservative. And basically what you're doing is you're scaling up and down based on whether the prior week was profitable, right? So you start with 2 micro contracts, you have a profitable week, you add a third contract, right? And then you trade for the next week, and maybe you had a losing week, you back down to 2 contracts. You have a couple of winning weeks, you add a contract on each week. And so what this will do is it's kind of a self-regulating mechanism, right? It's going to, when the market conditions are not all that conducive to trading, well, you're going to be trading more conservatively. And as you build up, pull you up from your own bootstraps, and you're having some winning week, now you're trading more contracts, and chances are it's not your trade setup that's failing. Chances are what it is the market conditions, right? So you're going to automatically scale up and be trading bigger size when the market conditions are good. So we'll talk about money management. To kind of sum this up, you can size your positions based on the current market conditions, the intraday ATRs and ranges. You can scale your number of contracts based on your prior week's performance and the overall market environment, right? And so to sort of take this concept a step further, you can trade with risk capital. I talked about that, alluded to that earlier in the presentation. So, here's the nuts and bolts. Like I said, we have a video on our site that gets into the details, but to trade with risk capital, basically you open an account with, say, $5,000 to start. Maybe you're a new futures trader and you want to dip your toe in the water. Instead of trading with that money, you promise yourself and your wife that you're never going to let that account go below $5,000 ever, no exceptions. And so what you do after you open the account is you send in additional risk capital. And if by, dumb chance that you burn through that $1,000 in risk capital, you got to send more money in, because you've made a promise to yourself and your wife that you're never going to let that account go below $5,000. So anyway, that's kind of it's a mental sort of thing. And we don't get into a whole lot of, like market psychology and mental type of stuff when it comes to trading, but this is a neat little strategy that will do a lot for your mindset. It'll give you the right approach mindset wise. Like I said, on our website, PowerEmini.com, if you go to the blog and then there's a little drop down, if you hit this featured articles thing, there's about a 40-minute, is really probably one of the best presentations, like videos I've ever seen on using this approach, how to trade off of risk capital. And so I gave it to you in a nutshell, but it's really, it's a cool video. Jeffrey did a fantastic job, so you might want to check that out. This is the last thing I want to talk about here is traders are at the mercy of market conditions, right? Ideally, every day is a great trading day. We get these big trend moves. We can take one of our, candlestick patterns with the high win rate. We got a good trade trigger, man. We jump in and boom, the market just takes off. But I hate to break it to you, but we don't get that, right? So a lot of new traders have a hard time that everything seems to be working, and then all of a sudden the market conditions are terrible. So anyway, you're at the mercy of market conditions. Suboptimal market conditions will put a damper on any sort of trading. I'm going to have to jam through some of these slides here to get to the end. So if you want to watch the replay, you can see some of these interesting little points here that I've made. But what I want to do is, yeah, there's an example of a tough to trade day, right? So try your trade setup on a day that looks like that. Anyhow, here's an example from a while back that, speaking of market conditions, when the markets are trending, you tend to get better intraday trading. This is a daily chart. When the markets are in these little consolidation phases, the trading tends to be choppier, right? This is a slide that shows, great trading days, okay trading days, tough trading days. Pretty self-explanatory, but this is the kind of stuff that I think new traders don't appreciate fully. So here's basically a summary of what I just talked about. And I kind of blazed through the last part there because I noticed my time's running out, but more on this stuff at our website, PowerEmini.com. There's a lot of things we can do to refine our trading beyond the standard trade setup. So if you spend all your time looking for the holy grail trade setup, you might think about some of these ideas to improve your process. Let me know what you think of these ideas, and if you have any questions or comments. I don't believe I'm going to have time to take any questions here. So this is the first time that I've ever done a Festival of Traders presentation, and so I'm interested to hear what you guys think of it. So 30 minutes is, it's a challenge to put together a good educational type of presentation in 30 minutes. So we do have, I briefly touched on a trade plan. Most of these strategies are covered in more detail on our website. So feel free to poke around there. Feel free to email me and let me know what you thought of all this. And then, of course, I want to close by reiterating the idea that we are a software company, right? So, way back in 1998 and 2000, we were building, they didn't call them algos back then, right? Back in those days, we were building trading systems, right? We were looking to find ways to automate stock picking, find ways to, find good trade setups, all that good stuff. Well, here it is, all these years later, we developed a software program that basically gives intraday trade alerts for ES. And just about everything I talked about is incorporated into that software. And if you want to check it out, go to PowerEmini.com. If you want to see more details and all that educational stuff, well, pop over to our website and check that out too. Hey, Dave, I appreciate you having me on. That's it for my presentation.